Alright guys, so we are into the secondary markets, if I remember well. New York Stock Exchange, NASDAQ, some of the biggest. I mentioned last time a trading post, okay? We did a trading post, the specialist, right? Market order, okay, types of orders. There are two types, let's see, of brokers. There's what's called a commission broker. And a floor broker. So, a broker, now that's where I can zoom in a little bit so that it's easier to see. I can also bring the camera closer to be more convenient. Alright, so a broker is a market participant that executes trades for others. He doesn't buy for himself, he's only an intermediary. Floor broker is usually a member of the exchange. He is part of the exchange. And a commission broker will be usually doing trades for retail customers. Usually a commission broker will be a member of a financial institution, but not a member of the exchange, okay? And the commission broker will be dealing with the specialist. So the specialist is the guy who does the trading. The specialist is a dealer. Now let's try and make sure you understand the difference between a dealer and a broker. A dealer buys and sells for himself. A dealer buys and sells for his own account. And the dealer will profit from the difference between a buy and a sell. A broker will execute for others. So a dealer, when he buys a stock or a currency, he owns it. If the stock goes down or the currency goes down, he takes a loss. If it goes up, it makes a profit. The broker will buy it for you. If it goes down or up, you take the loss. The broker works for a commission. And the dealer usually works for a spread. He tries to buy lower and to sell higher. All right. You also have now what is known as online trading, where the customer can use a web or internet platform to put in their trades. They want to buy something, they want to sell something, and this trading platform will connect to the exchange. Sometimes it will connect, let's say, to a financial institution. The financial institution, if it has the stock, will sell it to you, and then the financial institution will buy it from the exchange. So you may have here a customer. The customer will go to an online trading broker, and the broker will go to the exchange. So you want to buy a stock, the broker if the broker has the stock and is willing, will sell the stock to you. And later on, the broker, if they want, they'll buy it from the exchange. If you want to sell your stock, the broker will buy it, and then the broker will try to sell it to somebody else. But if they can't sell it to somebody else, they'll go to the exchange to sell it on the exchange. Let's see. You have, when you execute a trade, it's called a conformation. Conformation is a notice from the broker that your order, trading order, could be market order, could be limit order, whatever order, that your order was executed. In other words, if you wanted to sell, you sold. If you wanted to buy, you bought. Okay? Now there may be what's called a partial confirmation. A partial confirmation is, I want to buy 1,000 shares at this particular price, but they bought for you only 200. And they'll continue to work another 800. So you want 1,000, but they couldn't buy 1,000 at your price. They bought 200. Then maybe you're going to get a second confirmation for another 500. And then maybe last confirmation for the last 300. So confirmation is a notice from the broker that your order was executed, or that part of your order was executed. So that's confirmation. The next key concept is that of settlement. Settlement is a point in time where money and assets change hands. So settlement will mean that if you bought shares, 3 days later you will pay the cash, and 3 days later the seller will deliver the stocks to you. Usually, in this particular case, it's going to be the broker, because you keep your money to the broker, will pay to another broker, okay? And the other broker will deliver the securities, the stocks, to you. So here, there may be a different broker too, and one of them, if you bought, this broker sold. So after 2 or 3 days, there will be a settlement where the exchange will have an account for the one person, will have an account for the other person. They will just swap. On the one account, they'll put in the money. In the other account, they'll put in the stocks, if you bought stocks, right? So that's a settlement. So did I clarify last time the market order? Market order? Market order is simply an order to buy or sell. We say to transact at the best available price at the market. So whatever is the best market to buy, sorry, the best price to buy. That's a market order. Whatever is the market price right now. But it has to be at the best possible price. And a limit order specifies the price to execute, or better price, but cannot be at a worse price. So if you want to buy with a limit of $20, you can buy at 19, 18, 17, but you won't buy at 21, 22, or even $20.01. And I think I explained last time that in the market order, the quantity that you want to buy is guaranteed, but not the price. In the limit order, the price is guaranteed, but not the quantity. Next thing is called an order book. is a book with the market specialist at the trading post that keeps all limit orders. Basically, it will sort all orders by price. If they're above the current market price, these will be orders to sell. And if they're below, there will be orders to buy. If the price goes down, it will execute those orders to buy. If the price goes up, it will execute those orders to sell. The order book can give you a good feeling for what people want to buy and what people want to sell, or actually how much they want to buy and how much they want to sell at what prices. The order book provides a valuable information, and usually it's only the market specialist who can see that order book. Knowledge of the order book usually allows for others to possibly manipulate the market. All right. There's also a concept, at least on some of those exchanges, called program trading. Is the simultaneous order to execute a large number of trades, all of them at the same time. So it's a large number of orders, all of them at the same time, generated by a computer program. The definition requires at least 15 securities. So if you're trying to buy more than 15 stocks at the same time, worth more than $1 million. But that definition can change. It can change to 30, it can change to 5, the million can change to 10 million. That's not the important part. This is just a technical part. The important part is that it is an order generated by a computer to buy and sell a bunch of stocks. Now, it could be buy these 20 stocks, sell these 30 stocks, okay? It could be buy only these stocks and maybe sell something on some other market, like a futures market. That's program trading. Another very advanced concept, very difficult to explain because it's advanced, is portfolio insurance. Is a concept where a fund will attempt to program trade. In other words, they're going to try to sell a bunch of stocks or buy a bunch of stocks, or they'll buy indexes on stocks in order to protect their portfolio from losses. Usually portfolio insurance works when you have stocks and your stocks begin to fall, you will sell futures. And as the futures market goes down together with the stock market, you will be making gains or profits on your futures account, which will offset your losses in the stock market. So it will partially compensate you for your stock market losses. That's portfolio insurance. Is basically making program trading that will partially compensate you for losses in one market by trying to generate gains in a different market. All right. Exchanges will introduce what's called a trading curve. A trading curve is a limitation on market trading or restrictions in market trading if the market moves too much, usually on the downside. So the market falls more than 5% or more than 7%. A trading curve will mean maybe stop the market from trading for 10 minutes or stop market trading for 15 minutes. It could be, and it's usually used in futures markets, it could be used in options market, could be used in stock markets. So as long as there's an organized exchange, the exchange can introduce trading curve rules. So if the market recovers, the trading continues, okay? But if the market falls further so many percent, let's say up to 10% maybe. Again, trading curves will be different for different countries. In Japan it may be at 6%, in China it's at 10%, let's say in the US could be 12%. I'm making the numbers, but you gotta understand that trading curves are not uniform throughout the world. So, you in your market, the trading curve may be very different from that of Thailand, or that of the United States or the UK. It could be very different. Or you may not have a trading curve at all. So the first is called a temporary halt. To halt means to stop. So you just stop trading for 10 or 15 minutes. It's called cooling off. And then trading resumes, meaning they continue to trade again. And if the market still keeps going down too much, then it's going to be, after the temporary halt, it's going to be a daily halt. It doesn't mean that the market will not trade for a day. It means it will stop trading till the end of today. So it may be 2 o'clock, maybe 3 o'clock, the market closes at 4 o'clock. So if it hits the daily halt, let's say at 2 o'clock, it will just stop trading until the end of the day. Tomorrow, the market will resume with the same trading curves, okay? There may be a special type of trading curves which affect only short selling. Where there is a special limitation only to selling short. So now I need to explain what is short selling. Short selling is to borrow an asset and sell it on the market. In other words, short selling is selling an asset which you don't own. So you borrowed it to sell it. And then, so you sold it. Let's say I borrowed her shares. I sold it to you, okay? And then, when I'm done, it's called short covering. I go on the market, I buy the stock from her and return it back to the person that I borrowed from. So, in a short covering is the same as buy. So, in a short selling, the first step is sell and the second step is buy. You sell short, hoping the price to go down, and then you hope to buy cheaper and make the difference. In a regular trade, the regular trade, You first do buy, hope the price goes up, and then you do sell. Short selling can apply to stocks, can possibly apply to bonds, it can apply to currencies, okay? It can even apply to gold, to commodities. The difficult asset to apply to is real estate. I can't just borrow your house to sell it and then return the same house. Okay? I can borrow $100, I can sell it, convert it to yen, and after a month I can give you some other $100. There's still going to be 100, but it's going to be different $100. You can do the same with gold. You can borrow a ton of gold, I sell it short, and I can give you another ton of gold. Very easy to see and understand is a barrel of oil. I can borrow a barrel of oil, and a month later I'll give you back another different barrel of oil of the same grade and the same quality of oil. Of course, it easily applies to rice, to any other commodity in general. Next. Well, next one is basically a stock quote. A stock quote will give you basically the price. It will tell you what is the bid price. Basically, let's say, well, do I have my phone? Yeah, I do. Yeah, let's try and use these little toys productively. So I open right now, and let's take a look at the. Let's take a look at the price of gold. Bid is $12.94, and the ask is, well, that's the ask over here is $12.95. Okay, so that's a simple stock. Well, in this particular case, I'm using gold. Okay. But I can come up with some other. I have here copper, I have here something else. So, they offer $1.94 and $1.95. You want to sell, they will give you $12.94. You want to buy, you can buy for $12.95. Usually, but not everywhere on the internet, you'll also be given for the bid the quantity. The quantity here will be 100 ounces of gold or 100 shares, okay? And here the quantity could be 500 ounces of gold or, let's say, 500 shares, or this is called the market depth. In other words, how many shares you can execute at this price. So if you want to sell, let's say if you want to sell 200 shares, the first 100 will be at this price. But then the price will change. The price will probably fall a little bit. So that's a stock quote. And then you can have a stock quote list. They still use these in the textbooks, but they're now not anymore. Is how they tell you in the newspaper about a particular stock. They'll tell you what's the price at which the market opened. Then they'll tell you what's the high price for the day. Then tell you what's the low price for the day. So tell the market opened here, it went, the highest price was this, the lowest price was this. Then what's the close price, you know, where the market closed. What's the change? What's the change from the yesterday's close? And finally, the volume. How many shares? Maybe 1 million shares of Apple, maybe 30 million shares of Apple, maybe 50 million shares of Apple. Okay? So basically this is a stock quote list. And underneath it's going to be the next stock, and the next stock, and the next stock. And you may open, let's say here is on page 238, where you can just see how it's done in the newspaper. 238. It's a little chart. Of course, you can go on Yahoo Finance, on Bloomberg or CNBC or any other place, and you can just look at their stock quotes or stock quote list. You may just say, give me the stock quote list for Dow Jones companies. All right, let's see what else we got here. So the markets, I think, explained will be either organized exchange, meaning the secondary markets, financial markets will be organized exchange, which will be usually physically located in one particular place. And it's going to have a lot of trading pits and all the other stuff. Or it could be over-the-counter market. Without any particular location. The best example of over-the-counter market will be exchanging currency. Currencies you can exchange in town almost anywhere, and there will be hundreds of little shops. There won't be one single place. So the exchange is characterized, the key characteristic is that it is organized. It is an institution. It's got a name. It's got a location. Usually it is designed to be for profit. It will have rules, it will have regulations, to have members, everything's very well organized, okay? And the exchange will try to work, of course, for its own benefit, but it will have to compete with other exchanges. So, some of the exchanges will be, I already mentioned before, I don't want to get too much into that because that's too much, is Amex, okay. Another one which is a little trickier, NASDAQ. NASDAQ is kind of like over the counter. I don't want to get into these details at least right now. That's again, the goal is not to study specifically US stock markets. I mean, we might study as well the Chinese markets or the Singaporean markets or the Hong Kong markets. Okay, they're getting almost just as big, or European, German, British markets. So you got the NASDAQ and all the other stuff. And the NASDAQ has a characteristic, what is called, and that's a general concept, ECN, which stands for Electronic Computer Network. In other words, a lot of exchanges around the world, especially over the counter, will be ECNs, will be Electronic Computer Networks, okay? Where a whole bunch of computers will tie together, maybe 10 computers, and 10 different institutions will be putting in their quotes, their bids, their asks, they'll try to trade, and then others will hook up to those institutions. So it's going to be literally a network of many computers, but there's going to be a central ring around them, you know, maybe central 5 or central 10 computers that will be executing between each other, and then everybody will try to hook up to these 5 or 10 computers at the very ring, at the core. That's an ECN. Next one. If you want to be traded, meaning if your stock has to be traded on exchange, an exchange will have what is called listing requirements. So we need to say what is listing. To list means actually to trade or to accept a stock for trading on an organized exchange. So that's listing. If a stock is listed, means that the stock is tradable on the exchange. It means that you can buy and you can sell it. It means that probably there will be a market maker for the exchange. Probably there will be for the stock. It will be working. So listing requirement is a minimum requirement imposed by an organized exchange to list a stock. So, if you have your little company and you want to trade on the exchange, there will be certain requirements. You may have to have so many employees. You may have to have so many years of history. You may have to have so much revenue and all the other stuff. So, whatever the requirements are. For example, they'll be looking at your overall company value. How much is your company worth? They'll be looking at your earnings. Are you generating enough profits? They'll be looking at your assets. Do you have a lot of assets or a few assets? Number of shares, number of and so the other things. So now we get to, well, I'll delete and continue to explain some of the basic benefits of listing. Now, if you have a company or any company, why the company would want to trade or its shares to be traded on the exchange. So, what are the basic benefits from listing? Again, especially listing on a major exchange. The first big one, of course, is publicity. You become public. You become popular. You get in the news. People talk about you and about your company. So, publicity also gives more and provides more confidence. Confidence in suppliers, confidence in customers. Okay? So, it gives you basic confidence. Part of publicity is basically you almost get like free advertising. Every day people on the stock exchange talk about Apple, what Apple did, what Apple had, what's the new product, you know, all the other stuff, you know. Basically, you get to learn more about the company. The second biggest one is, of course, the primary reason. Financing, meaning access to funds. Easy to raise capital. You want $20 billion? You can sell shares, maybe for $1 billion, maybe for $20 billion. So the primary reason is financing. Remember, to finance yourself, financing is on the primary market, okay? Not on the secondary. But from the secondary one, once your stock is traded and everything else, they could be easier to issue. It could be, so it's not financing, it's easier access to financing. So, if you've never had your shares traded before, it's a lot harder to raise $1 billion. But if your shares have been traded for many years, you already have the publicity, it's a lot easier, okay? The third one, of course, is probably one of the most important, is called price discovery. The major benefit of a secondary market is that you can see what the price of the share is. Millions of people buy, millions of people say, so it is a consensus of what maybe a few million people think is your share worth. So you can see what's going on with your stock. Also, price discovery means that you can see what others think you're doing. If your stock is going up and trending up, means others approve of your business, of your operations, of whatever you're doing. If your stock's going down and down and down, others think that something is not right, that you're not doing right things. So basically, it is a major source of information confirming whether you're doing things right or maybe a sign of disapproval. In general, it basically tells you what the rest of the world thinks about you. Let's see what else. So, stock market, next one. Well, these are pretty much the main benefits. Let's see what else we have. So that, well, there's a lot of stuff in here. Stock market index. An index is simply a number, just one single number that describes something, that describes a phenomenon. It could describe the health of the economy. It can describe your own health. It could be describing your heart health, okay? So, now in finance, the US dollar index will tell you what is the dollar worth relative to 2, 3, 4, 5 different currencies. So, you can have a currency index, usually mean the value of one currency against, it's an average of the value of one currency against maybe 3, 5, or 20 other currencies. You could have a commodity index, which will be a number, usually an average, between some of the most important commodities, like oil, gold, maybe iron, maybe copper, okay? And of course, for all of you guys, rice. For all Europeans, wheat. For all Americans, corn. So now commodity indices, right? Well, let's kind of like throw in a little extra, right? Could be for metals. Gold, silver, copper, zinc. They could be agri. Cultural, okay, for agriculture. Rice, wheat, corn, whatever, right? They could be, what else? Commodities. Energy. Oil, gas, okay? Oil, gas, coal, okay? And so on. And of course, index could be for stocks. In the US, the most popular is Dow Jones Industrial Average. It's an average of 30 major stocks in the United States. Okay. Well, let's try another one. In Japan, it's going to be the Nikkei, sometimes pronounced on TV as Nikkei. Okay. So that will be another one. Now we have the German index, you got the French will be CAC. The German will be called DAX. Okay, so each market, let me see, S. I think that's how it is. It's the Shanghai index. That's the Shanghai Stock Exchange Index. Is getting relatively more important. Well, just checking this morning, it's at 2,950 or whatever. All right, so you have different stock indices, and of course, for one country, it could be many. So the Dow Jones will be only 30. The Nikkei is going to be 225 companies. So I think the DAX is whatever, 40. So you need to understand first the stock index, then you need to understand what is it. So for example, now there are new indices. You take the Japanese, Chinese, Australian, and all other Asian markets, and you get one Asian index. You got about 8 or 10 European markets like German, British, French, Italian, and so on. You get one European index. Then you get US, different markets, whatever, you get one US index. Or you can get one US and Canadian index, North American index. So you can generate any kind of index, which is basically going to be some sort of a weighted average from a number of other prices. All right, so what I'm going to talk about New York Stock Exchange, okay. That's it. Next. So we could be finishing with the stock market. I think it's almost the last section, pretty much the last section. Number 7, page 243, stock market participants. Those that invest a lot, remember, they're all investors. In the secondary market, you don't have any other participants. They're all investors. So, mutual funds, they basically invest mostly in stocks and bonds, but they could invest in other things. Second will be pension funds. Again, they invest mostly in stocks and bonds. Mutual and pension funds are usually long. They invest mostly on the long side. They don't short. The next category, not necessarily the biggest, will be hedge funds. They're basically mostly on the speculative side. They buy a stock because they think it's going to rise a lot, or they sell a stock short, expecting it's going to go down or go bankrupt. Well, you may have just individuals. We call these households. Of course, big one will be commercial banks. It's important to understand in the US there are major restrictions of commercial banks buying and investing into stocks. But there are no restrictions in Europe. European banks can buy stocks all they want. Japanese banks can buy stocks all they want. So in other countries around the world, commercial banks play a major role, both as buyers and investors, occasionally as traders. Of course, investment banks and also brokers. Now, a broker is just a participant. We call the financial institution brokerage house. They're given with investment banks because usually a brokerage house will be an arm or a branch an investment bank. So investment bank will have an investment banking division and a brokerage division. If they don't, they'll usually acquire, or they will have an affiliate, someone associated with them. Let me see what we do. So, okay, well, other issues pertaining to stock markets, well, maybe I'll just finish next time. All right, is this good enough for today? All right, thank you.